Welcome to Sock Talk, everyone. Get ready for another deep dive. Today, we're zoning in on the RealReal, specifically their Q1 2025 financial results. We've got the analysis, the earnings release, everything from May 8th. Our goal, simple, cut through the noise, give you the key insights on where they stand, where they might be headed. No finance degree needed. And hey, if you enjoy what we do here, please do like, subscribe, share the podcast. It really helps.
Absolutely. And there's something pretty interesting right out of the gate with this one. It looks like the RealReal reported positive adjusted EBITDA. And this is for Q1, which, well, it's usually their weakest quarter.
Huh. Okay, positive adjusted EBITDA in Q1. That is interesting. Usually a slower start to the year for retail, right?
Exactly. So it definitely caught my eye. It suggests something might be shifting.
All right, well, let's unpack the overall financial picture then. How did the top line look? What were the main numbers?
Okay, so headline is growth. Revenue was up 11%, hit $160 million compared to last year. And their gross merchandise value, the total value of stuff sold, that grew too by 9%, reaching $490 million.
Solid growth numbers then. 11% revenue, 9% GMV.
Yeah, pretty solid. But here's where you need to look a bit closer. Net income. They reported $62 million in net income, which sounds amazing, right? Especially coming from a $31 million loss last year.
Wow, that's a huge swing. From negative $31 million to positive $62 million. What drove that?
Well, this is the catch. A very large chunk of that, about $80 million, came from non-cash gains.
Ah, non-cash gains. Okay, so not actual cash coming in from selling more luxury goods necessarily. Explain that a bit.
Exactly. Think of it like value adjustments on paper, changes related to things like their warrants or debt. It boosts the net income number, but it doesn't reflect the core day-to-day business performance in the same way cash from operations does.
Right, so for that core performance, what metrics should we be looking at? You mentioned adjusted EBITDA earlier.
Precisely. Adjusted EBITDA strips out those non-cash items, interest, taxes, depreciation, amortization. It gives you a clearer view of operational profitability. And on that front, like I said, they hit positive $4.1 million, which is a really nice improvement from negative $2.3 million in Q1 last year.
Okay, so that positive $4.1 million adjusted EBITDA feels more significant in terms of like operational health turning a corner.
I'd say so, yes. It shows the underlying business operations generated a profit before those other factors. Oh, and their gross margin also ticked up slightly to 75%.
Got it. So flashy net income number aside, the positive adjusted EBITDA is the real signal here. What about the platform activity itself? Are more people using the RealReal?
Yeah, seems like it. Some good signs there, too. Active buyers increased by 7% year over year. They're now at 985,000.
And that's important because...
Well, what's interesting is that this actually reverses a decline they saw last year. So attracting buyers back, or new ones, that's key. Plus the average order value, the AOV, that went up 5%, now $564.
So more buyers, and they're spending more each time they buy.
Exactly. And the total number of orders was up, too, by 3% to 869,000. So yeah, more engagement.
Okay. And what about the take rate? That's how much the RealReal actually keeps from each sale, right? How's that looking?
That improved slightly as well, up to 38.6%. And, it's not just a one-off jump. We've seen this metric kind of steadily improving over the past year, suggests they're getting better at monetizing the platform.
Consistent improvement is good.
Right. And another related point, their net merchandise value, or NMV, grew by 11%.
NMV. Remind us what that is again.
Sure. It's basically the GMV, that total value sold, but after you account for returns and cancellations.
Ah, okay. So NMV growing faster than GMV.
Yeah.
What does that tell you?
It tells you they're managing returns and cancellations better. Fewer sales are falling through, essentially, which points towards, better operational efficiency, maybe higher customer satisfaction.
Makes sense. Fewer returns means more actual revenue sticks.
Okay.
Okay, so we see growth, more engaged customers. Where's the revenue coming from? Is it still mostly consignment?
Consignment is definitely still the biggest piece of the pie. It brought in $123.8 million. That was up 7%. That's their bread and butter.
Okay, standard model.
But the real eye-opener was direct revenue. This is where the RealReal sells inventory it owns itself. That segment grew by a massive 61%, to $20.5 million.
Wow, 61%.
Yeah.
That's huge growth. What's going on there? Is that a deliberate strategy shift?
It Certainly looks like it could be. I mean, growing that fast suggests a real focus. Owning the inventory gives them potentially more control over pricing, maybe better margins down the line.
But also more risk, right? Holding
Sure.
inventory costs money.
Absolutely. It's a different model, more capital intensive, carries inventory risk if things don't sell. But that growth rate is definitely something to watch. It's diversifying their revenue streams.
Interesting. What about other revenue like shipping?
Shipping services revenues saw a small increase, about 2% to $15.8 million. But they did note the margin on that dipped a bit because shipping costs went up.
Right. Shipping costs impacting everyone. Okay, so revenue's up. Adjusted EBITDA is positive.
Yeah.
But what about the actual bottom line, like operating profit or loss?
Their operating loss did get smaller. It was $12.8 million this quarter compared to $17.9 million last year. So an improvement.
Still a loss, but heading in the right direction.
Yes. But again, you see the big difference between that operating loss and the $62 million net income we talked about earlier.
Yeah, that $80 million non-cash gain effect again.
Exactly. The warrant liability, debt extinguishment gains, they bridge that gap. So it's crucial to keep that distinction clear. The underlying operations, while improving, are still running at a loss on a GAAP basis.
Understood. So net income looks good on the surface, but driven by non-cash items.
Yeah.
Operating loss is improving, but still negative. But that adjusted EBITDA is positive. That's the key operational win.
That's how I see it, yes. It shows the core business engine is starting to generate cash before those other accounting and financing factors. And another positive sign, their operating expenses, things like marketing, admin costs, they grew, but slower than revenue did. That suggests improving efficiency, better cost control.
Okay, better leverage.
Yeah.
But you mentioned cash earlier. How is their actual cash flow looking?
Well, that's one area that's still a concern. Free cash flow was negative $35.8 million for the quarter.
Ouch. And how does that compare?
It actually worsened compared to Q1 last year. They said it was mainly due to higher cash outflows from operations and also more investment back into the business, like capital expenditures.
Okay, so generating positive adjusted EBITDA, but still burning through cash. That's a dynamic we need to watch closely.
Definitely. Managing cash flow is critical, especially when you're still technically making an operating loss.
So what are they saying they're doing about all this? What are their strategic initiatives moving forward?
They talked a lot about their growth playbook. They're crediting it with bringing in the highest number of new consigners they've seen in over 2 years.
Growth playbook. Sounds like marketing speak, but okay. What does it involve?
It seems to be about better integrating their sales efforts, marketing, and their physical stores. They're also planning to expand their store footprint and focusing marketing on attracting, high-value consigners and buyers, plus a big push on using AI.
AI. Where are they applying that?
Key areas seem to be things like authentication, making it faster, more accurate, and also potentially helping with pricing optimization.
AI for authentication. That could be huge for building trust in the secondhand market, couldn't it?
Absolutely. Trust is everything in luxury resale. They're also generally stressing improvements to the whole experience for both sellers and buyers and really leaning on their human authentication expertise too.
Okay, makes sense. Did they give any guidance for the next quarter or the full year?
They did. For Q2 2025, they're guiding for GMV between $476 and $486 million, revenue between $157 and $161 million. And adjusted EBITDA is expected to be between $3.0 and $4.0 million. So staying positive there.
Similar range to Q1 then for adjusted EBITDA.
Roughly, yeah. And importantly, they reaffirmed their guidance for the full year 2025. Management sounded pretty confident despite, the general economic uncertainty out there. They even mentioned a potential upside from tariffs, oddly enough.
Tariffs. How would that help them?
Their thinking is, since they source most of their goods domestically from consigners within the U.S., potential new tariffs on imported luxury goods could make the secondhand market, like them, relatively more attractive.
Interesting angle. Okay, so putting it all together, what are the main opportunities and, I guess, the risks that stand out for the RealReal right now?
Well, on the opportunity side, you've got that booming direct revenue stream if they can manage it well. You've got the growing active buyer base and higher AOV, the potential efficiency gains from AI, and maybe that tariff tailwind, though that's more speculative.
And the risks.
The big ones are still there. Macroeconomic uncertainty hitting luxury spending, the fact they still have an operating loss and negative free cash flow, despite the adjusted EBITDA progress. Competition is always fierce in this space, and managing their existing debt load effectively.
Okay, a mix of promising signs and persistent challenges. So for you listening, what are the absolute key takeaways from this Q1 report? What should you really remember?
I think number one is the positive momentum. Revenue is growing nicely, and hitting positive adjusted EBITDA in Q1 for the first time is a significant milestone for their core operations. Number two, customer engagement seems to be improving, more buyers spending more. That reversal of the declining buyer trend is important. Third, watch that direct revenue growth. It's a potentially big shift in their business model.
But with caveats, right?
Right. Fourth takeaway. Look past the headline, net income. Understand the impact of those non-cash gains. It's not the same as operational profit yet. And finally, keep a very close eye on whether they can sustain that positive adjusted EBITDA and, crucially, start improving that negative free cash flow situation. That's key for long-term health.
Right. So progress on several fronts, revenue, core profitability via adjusted EBITDA, customer metrics are up,
Mhm.
but the gap profitability, the actual cash generation, those are still works in progress.
Exactly. It's a bit of a balancing act. They're showing they can grow and start to operate more efficiently. The big question, I think, for you to consider is how will they navigate this next phase? Can they keep the growth engine running with these initiatives while pushing towards sustained actual profit and positive cash flow, especially with the economy still uncertain and competition breathing down their necks?
A crucial question indeed, something to think about as we watch the RealReal's journey unfold.
Definitely. And hey, if this deep dive helped you make sense of it all, please remember to like, subscribe, and share Stock Talk. It lets us know we're heading in the right direction.